Ganeshram Jayaram, Managing Director and Head of Avendus Spark Institutional Equities joins us now. Let's connect with him to understand what he makes of the current market setup. Ganesh, good morning. Thank you for joining us. We've seen a bit of a here and there kind of a move in large cap stocks. And last week's price action, if anything is to go by, was slightly damaging. What is your market assessment? Do you think we've peaked out for the year, or right now we could just see a sideways market with no big sparks?
Morning. Good speaking to you all. I think, we've been little on the cautious side on the markets. It's been a very dichotomous economic recovery. Okay, in the sense, in the last, say, 6 months, maybe even 9 months, consumption has moderated quite significantly. And that's something that we are watching. Why this kind of moderation? If you see various categories, including FMCG or QSR space or the innerwear or across apparels, even categories on auto, there is a moderation in volume growth. Okay. Pricing has been pretty okay. Price hikes were taken last year, and since then, raw material prices had eased up, so gross margins improved, and that led to kind of operating leverage play out. But volume growth is what we are watching, and that's moderating. We are keeping an eye out. Exports, okay, that's also moderated in a way, in a quite a significant way, including IT services exports. IT companies headcount has been moderating. Naukri jobs index not showing great trends now, almost 6 months. That's one side of the picture, the whole domestic consumption side of things. But that's possibly at, I'll say, almost like a lows in a decade kind of a consumption pattern. But what's at a decadal high is the whole manufacturing, industrials, capex drivers. Okay, when you look at how the capacity utilization is picking up, the balance sheets of large corporates, the capex announcements, the sanctions by banks, that's picked up very significantly in the last 6-9 months. The whole MNCs looking at India on for not only their services side, global capability centers, but also their whole manufacturing side. So very dichotomous, slowing consumption and industrials picking up, and that's something that we are penciling into our top picks and model portfolio that we are recommending to clients. This is a very important change. 2010 to 20, the drivers of the economy were demand, consumption, retail loans, whereas the last maybe 18 months or so, it's been more of the whole supply side of it. From demand to supply is the swing, more of who's creating capacities, who are the beneficiaries of that capacity, and that capacity is coming in property, it's coming in manufacturing. So the portfolios need to reckon and recognize this, and that's what we have been telling, and we continue to be more polarized in our whole stock picking and construct of our top picks.
Ganeshram, just playing devil's advocate here, and let's talk about the brightest sparks, and let's pick up on the point that you were making about capex. Large part of the capex is actually government-led. Do you not think that it's going to peak out in FY24, because soon we're going to be stepping into election year, and then there's always that overhang of not exceeding too much on the fisc?
No, I think you're right. Government capex will possibly peak out in current financial year, but who will take over the baton on the capex side of things will be the private sector. That's what we are working with our views on, that the private sector capex, the drivers of which are already visible, and PSU companies as well. Okay, they will also be driving capex, and they will also lead to the broader economy's drivers moving from government capex to private capex. So you're right on government capex.
Ganesh, while I'm with you when you say that the consumption patterns are slightly puffy-duffy, but if one looks at a very basic benchmark, which is that the credit growth, what banks are reporting, especially for retail credit, those numbers are looking very, very smart. So if retail credit is growing, which could be unsecured, car loans, even it could be gold loan, why are they growing then?
That's the dichotomy. That's the $1 million question. Are this kind of weakening consumption and rising personal loans are itself a concern? Okay, where is the money going? Is it being used to fund debt servicing? Okay, because unsecured loans are growing at almost 30%. So we are asking some fundamental questions on why this dichotomy between consumption and the credit growth. About maybe 20 to 25% of credit growth is going into the travel tourism angle, where we are seeing very good trends. You see the hotel rates, you see the the flights or the occupancy levels there. That's showing very good trajectory, but that can't answer this kind of growth in absolute terms. So very critical question on this dichotomy between credit growth in the retail loans and the weakening consumption side of things, especially mass consumption.
So, Ganeshram, to the point that you were making about private capex actually taking on when the government starts to ease off, who's going to stand to be the beneficiary? Because what we've seen is that the beneficiaries of the government capex have been very new themes, right? Your railways, defense, a lot of infrastructure as well. But what about private capex?
Very different names. Okay, it will be more of capital goods companies, equipments. It will be, this nature of capex is also very MNCs driven. Okay, and that means a lot of there will be quality names and not unknown companies which will be deriving demand out of this. So obviously, we are looking at various capital goods companies or companies more in captive power, or it could be in water treatment, environment treatment, sewage treatment, so the nature of industrials preference is also shifting for us from government spend beneficiaries towards private capex beneficiaries, and the names are quite different too.
Morning, I wanted to also get in your stance as to what the outlook in this kind of environment, with the fact that we're seeing high food prices, the currency as well coming under pressure, what this could force the Reserve Bank to do in the monetary policy?
If not for the inclusion of the bond index last week, we would have been more wary on the macro with oil at 95 odd. Given how the exports are behaving, this too would have meant that the current account deficit, which will still maybe double up in the second half vis-a-vis first half, and invariably that puts pressure on portfolio flows. Okay, and this would have played out, and if not for the bond inclusion, wherein due to that, of course, it won't come in the second half, it will come in June onwards, but markets will start expecting it, price it in. So and that's why the behavior of the bond markets, behavior of the whole call money, internet, overnight markets, the whole interest rate side of things, the whole how RBI will work towards it, those could get a little better. And that will actually ease up some of the macro concerns which were building up over the past month, and that's why market has been a little iffy in that sense. And globally also we will possibly we're getting into a kind of an air pocket on growth as well. So those concerns on that remain. At the margin, the whole bond inclusion news is in my view, a very important positive, getting into how we can absorb the oil shock if it continues over the next 12 months.
Your model portfolio, which you recommend to your clients, is talking about raising cash about 10%. That means you, in general, are struggling to find value anywhere.
That's true. I think, if IT and overall exports are slowing and consumption is moderating, given the valuations in the consumer side of things, we need to be a little more towards margin of safety. We're looking at managements who have a track record of performing not just when things are good, when there are tailwinds, but across cycles, right? You need to see the behavioral pattern on how they gain market share, how they create new opportunities, And so it's a very specific stock picking approach and not a more wider distribution that we are recommending. But some of them are expensive. So we think this approach of margin of safety needs us to keep higher levels of recommend clients to have higher levels of cash than normally they would have had. Of course, the confidence on capex is there, but how much proportion you keep there. Fourth is what we have recommended. That itself is much higher than the overall weights for the respective sectors. But rest of them, we need to be a little watchful, need better prices to deploy those cash.
When you say manufacturing is at a decadal high, could it be a multi-year trend where historically, I just want to bring this out for our viewers here, Ganesh, that when a big sector starts, the P multiples will always look out of whack because the sector growth will always surprise us. And if you look at IT or for that matter, fintech or a lot of companies, when they started a multi-year curve, at the beginning of them, the valuations were not 5-6 P multiples, they were always high. So could that be the story also for manufacturing, that yes, these stocks are up 50%, 100%, 150% from the recent lows. But if one is looking at terms of trends, this just could be beginning?
We believe so. In fact, asset turns of those companies are still quite low. Even operating margins are below, and those industries have consolidated. So if you let's take a case like, say, construction, right? How many construction companies are today left with to execute large projects? These 3,000, 5,000 crore projects, they're hardly maybe one or two. A decade back, they were, say, maybe 10 companies. Okay, so that means better pricing, likely better terms of trade on working capital or repayment terms. So valuations, even though they appear a little expensive than their long-term average, we are not faced by that. We are more comfortable recommending clients to pay higher multiples for either comfort in management quality or comfort in earnings growth quality, and not just growth, but also on the quality.
With something which in a sense resonates just with our viewers, that when you say comfort and good quality or management and good quality at reasonable price, what qualifies that cut?
So it's about the balance sheet quality. It's about the track record of managements who have performed well, how their market shares have evolved, even though in the down cycle, how they protected balance sheet quality, how they looked at market share vis-a-vis the peers who gained them. And that's what we are looking more towards, how their technology is better today to meet the kind of capex which is being presented, largely MNC-led capex, how they are positioned to take that potential. Those are the things that we are watching.
All right, appreciate your time. Thank you so much for joining in and giving us a sense as to what the outlook is when it comes to individual sectors, the capex cycle, as well as what the Reserve Bank could potentially do. A quick check-in as to what the